India's industrial output contracts at a shocking 1.8% in June, way below the industry's expectations of a 1% growth. The capital goods sector shrinks 27.9%. A disappointing day on the Lal Street, which snaps its three-day winning streak to end flat, led by RIL, SBI and Bharti. Market veteran Shankar Sharma does not see a big bull market in the near term, but bets India will outshine all the other equities. Tata Motors' first quarter performance meets street estimates thanks to JLR's strong operating margins. Strong Evoque volumes in China helped the company deliver a 30% growth in sales. Bharti Airtel plunges to a two-year low after brokerages like Goldman Sachs and Standard Chartered downgrade their ratings for India's top telecom company. Another legal tangle for Infosys after Jack Palmer, another former employee, claims that the IT company misused its D1 visa, files a suit in a California court. The 165-kilometer-long 6-lane Yamuna Expressway connecting Noida and Agra is inaugurated. Manoj Kaur tells CT Now he is expecting 200 to 250 crore rupees as revenues in the first year. Good evening, you're watching Business Day and I'm Nisha Poddar. Straight to the big story of the day. India's industrial output contracted at a shocking 1.8% in June. The capital goods sector has witnessed a sharp contraction of 27.9%. Manufacturing remains under pressure as well. It contracted 3.2%. Now, factory output has now contracted for the third time in 4 months in the month of June, increasing pressure on the government to fast-track reforms. And Montek Singh Ahluwalia, the Deputy Chairman of the Planning Commission, said the IIP numbers have indeed been disappointing, but he has assured that with the announcements that P. Chidambaram made in the recent past, the situation will definitely turn around.
The industrial numbers have been disappointing for the first few months. So these numbers only confirm that. The Finance Minister very recently has made a very substantive announcement that the government is determined to take all kinds of steps, and we mentioned several of them, that will turn around the situation. Now remember, the data you're talking about is the data up to June. So I mean, the government has been looking at it. Growth this year is more likely to be between GDP growth, between 6 and 6.5%. And I said that more than a month and a half ago. I think we will take a final look at it, and you will know our assessment probably by early September.
And here are some more industry and market voices on the weak June IIP data.
The sound bites that you're hearing from the government and the new regime are sounding positive, but too less an action. I mean, are they two delayed actions taking place? So I'm sure this would be a real early warning from the government's point of view to be able to take actions faster than what speed they have taken so far. But it is clearly a demonstration of the pace at which the economy is slowing down.
My sense is this is good in the limited sense that this will probably prompt some policy action going forward. As the agriculture output begins to come down, this will have a knock-on impact, a cascading impact on the entire rural infrastructure, which is the services sector. And services, remember, is the area that has kept growth up. Even as industrial growth has cratered, agricultural growth is coming down. Services has remained robust. The rural demand story, even the urban demand story has remained more or less fairly stable. And this is the one that is likely to bring down growth.
But right now, IIP numbers as of now are continuously dismal. When we don't believe that rates of interest have been the major factor in slowing down the economy. The main ingredient is the lack of facilitation in the projects, hundreds of crores getting stuck. You just tell me 1% rate of interest higher matters much less than a 2-year delay to any entrepreneur in his project, which can add up interest cost and revenue delay much longer.
There has been a slowdown in discretionary items, so it will impact maybe, we have already seen some impact in other industries like say a pickup in auto and housing loans and I think entertainment, apparels. So obviously it will also affect top-end discretionary even in FMCG. If there is food inflation post-drought, that will lead to perhaps down trading and titration of consumption of basic goods.
Okay, disappointing set of numbers as far as IIP data is concerned, and a disappointing day on Dalal Street as well, which snaps its 3-day winning streak to end flat. And this was led by the big boys like Reliance Industries, State Bank of India and Bharti Airtel. Tanveer Gill joins us with a detailed report.
Well, it was a fairly volatile session for the market. The disappointing IIP data brought us lower in trade because we were trading above 53.50 at one point in time. So from the high point of the session, the market actually in a volatile range got readjusted and closed at the lower end at about 53.20 in the session. What's important is that there was a lot of stock-specific activity. The broader trade for the market seemed a bit bearish. But in terms of stock-specific activities, certain counters such as an M&M stood out on the back of earnings from yesterday's session. That one was able to register a decent performance. We also had some of the defensives in an HUL that did well for themselves in trade. Some of the banking names and some of the commodity names were also able to hold out. On the losing side, the fairly aggressive sell-off came in some index heavyweights. Bharti Airtel, this is 15% down in 2 straight sessions for the stock. 6% plus in today's trade, and of course 6% plus in yesterday's session. And aside of that, there was also weakness seen in Ranbaxy post the earnings, and SBI, a big heavyweight, ahead of numbers given the asset quality concerns for PSU Bank. That stock was down about 4.5% in the session as well. The broader markets, not much to write home about from there as well, as the small cap and mid cap indices also closed down in the red. In terms of stock specific activity, we had a fair number of liquid stocks give way in the session. Some of the mid-tier banking names were down, fertilizers, and even sugar continues to be in correction mode. However, there was some standout performance purely on the back of earnings. Remains to be seen how the future pans out, but right now volatility seems the name of the game in the session. For example, a stock like Aurobindo Pharmaceutical also lost at about 7% in trade. So volatility really is the order of the day for the market.
We like selectively cement companies in the mid-sized companies, in the mid-cap space, given the fact that most of them have come out with fairly strong results on the volume growth and realization improvement. We are underweight on the larger FMCG space because of the rich valuations. We are underweight on metals because we believe that metal prices over a period of time are headed lower.
You know, I think there are opportunities, particularly at the sort of smaller cap level. There are a lot of company-specific opportunities right now. And we do have, obviously, cheaper levels. We have had, certainly prospective PEs really come off quite a bit. So there's quite a lot of value now. And I think, the oil prices or energy prices in general have come off slightly. India's actually looking much better value than it was a month ago.
Let's get you one more important voice on the markets. Market veteran Shankar Sharma of First Global does not see a big bull run for Indian equities and suggests investors to tone down their expectations from the markets. He, however, does bet on Bajaj Auto and smaller private banks.
To say that a big bull market is around the corner would be being foolish. It's a very challenging environment. I don't think those challenges are going to disappear. We've liked Bajaj Auto for a very long time, and obviously, when you like something, it doesn't mean that every quarter or even every year, will turn out to be okay. Again, now don't hold out a bet that Bajaj is going to go to 2,500. Again, within a challenging context, it looks like an outperforming stock. Tata Motors, when it was about 280 or 290, my thoughts on the stock were, which was about a few months back, my thoughts on the stock were that, just viewed in context of what has driven the numbers and what's been driving the numbers has been really the Land Rover part of the business and not the Jaguar part of the business. One has to be a little bit circumspect because when you make vehicles that are selling well but that don't look well, at some point, that disconnect will come out. So, you have to focus on the looks, and I don't think JLR is doing that on the Land Rover part as much as I would like them to do. I don't know the inside thing well enough to say that it's purely company or industry specific, but, looking at what TCS has been doing, One could say that Infosys could have done better. We've liked obviously the smaller private sector banks like IndusInd, etc. And we've liked the PSU banks like SBI and UCO, etc. We've liked capital goods stocks like BHEL, etc. at these valuations. We had downgraded the stock when it was about 2 times higher. But now at 225, 230, I think the valuations are compelling. Pharma look good. We've liked all these names for quite a while now. And they've been doing quite okay. Even the valuations are stretched. Still, you will do a lot worse than to buy pharma. Don't buy obviously telecom, Reliance if you're a trader. Otherwise, I would still stay away from the stock.
Okay, so that was all about the markets. Let's take you to the big earnings of the day then. Right now flashing on your screens are Tech Mahindra earnings, and they posted an 11% jump in the profits on QOQ basis, and the profit figures are at 338 crore rupees. The revenues at 1,543 crore rupees. That's again a jump of 9% on quarter basis. The EBITDA margins stand at 21.39% versus 16.86%, which is a good performance when the forex losses for the company stands at 24.2 crore rupees. So forex losses not that much for the company, and looks like it's a good set of numbers with 11% jump in the profits for the quarter. So that was from Tech Mahindra, but let's take you to other big earnings of the day. Tata Motors' first quarter performance meets street estimates on the back of JLR's strong operating margins. Now, strong Evoque volumes in China also helped the company deliver a 30% growth in the sales. And Kartika Srehan joins us for more detailed analysis on the Tata Motors numbers. Kartika, JLR really boosting the performance for the company, isn't it?
Absolutely. JLR performance has been one of the factors that the company's every quarter the growth has been visible. If you look at the entire consolidated results of the company, their net sales has been up about 30.1%, and also if you talk about their net profit, it's been up about 12.6%, completely in line with their expectation. But this is largely dependent completely on the volume growth of JLR, especially the Evoque. They launched the Evoque sometime in the month of November. Since then, they have seen a significant growth, close to about 91% growth in the Evoque sales. Also, the company's Jaguar XF has done pretty well for the company there. So largely dependent on the JLR growth, both in China and the UK market has done well. If you look at the profits from the UK subsidiary of JLR, that's also grown about 33.3%. Again, looking at the forex loss, the company has seen that 440 crore rupees of forex. So the factors that have been the matter of concern has been a better exchange rate, improved market condition. Now let me talk about the entire domestic market for the company. CV segment, which is the dominant segment for Tata Motors, that's not been performing too good. Other than the LCV segment, that's been doing pretty good for the company. On the other hand, passenger vehicle segment continues to be pretty weak for Tata Motors there. So yes, challenging factors going ahead. All right, domestic not that good, but JLR definitely boosting it. And let's go straight to Tech Mahindra results and the management speaking on that.
With 1% constant currency growth, revenue stood at INR 1,543 crores, up 19% year on year. In dollar terms, it was $281 million. EBITDA margin in Q1 was at 21.4%, an improvement of 440 basis points quarter on quarter. EBITDA in absolute terms was at 330 crores, up 37% year on year, and in dollar terms, EBITDA touched $60 million, up 26% quarter on quarter. The profit after tax, including share of associates, was INR 338 crores, up 22%. In dollar terms, it was $61 million. As you would be aware, global economic situation continues to remain volatile and uncertain. The most immediate risk seems to be emanating from delayed or insufficient policy action. Given our business inherent dependent on the state of the global economy, we are not insulated from economic events. Customers are scrutinizing all aspects of expenditure, including IT spend, and looking at avenues